Hi, today we will be discussing about swaps, a very important topic in derivatives. If you are employed or planning to join an investment banking arm or say treasury or risk management team in a bank or broker dealer who are dealing with derivatives on a daily basis, or you are aspirant for FRM or PRM or say CFA like examinations, then this video is very important for you. At the end of this video, you will learn about swaps, their purposes and certain types of swaps like interest rate swap and currency swap. Okay, let's start. Let us take a simplistic scenario where a bank has only one borrower and has only one depositor. Let's say that the bank has lent around 100 million US dollar to the borrower. So the bank is earning interest on top of this 100 million, and this money the bank has raised from the depositor. That means the depositor has deposited money with the bank and bank has to pay back the interest to the depositor. Assume that the bank has promised an interest rate of 8% to the depositor and the borrower has agreed to pay to the bank at a LIBOR plus 4% interest rate. So on the $100 million, the borrower is going to pay every year LIBOR plus 4% interest, and the bank is going to pay back to the depositor 8%. So as long as the LIBOR remains above 4%, the bank is going to make money, because this interest rate that the bank is going to earn from the borrower will be above 8%, so that bank can retain some amount of margin and then it pass the 8% amount to the depositor. The moment the LIBOR goes below 4%, the interest that the bank is going to charge to the borrower will fall below the 8%, and then bank will come to the negative margin. So the bank has to safeguard itself, otherwise bank will have to undergo the bankruptcy. So what it has to do to safeguard its interest from the volatility of the interest rate, it has to find an instrument which can guarantee the interest rate of more than 8% so that it can preserve its margin. So it will go to a dealer which will essentially help him hedge its interest rate risk. So the dealer is essentially trying to tell that, okay, I am ready to give you 8% or more than 8%, let's say 8.25%, but in return you give me LIBOR plus 4%. If the dealer is convinced that the LIBOR is going to go up in the future, then it will say that, okay, I am convinced that the LIBOR is going to go up, so therefore I am promising you, or I am promising the bank, that I will give you the 8.25% interest provided you give me the LIBOR plus 4%. Now this is called a typical swap. The bank is swapping or exchanging its floating rate payments with the receiving of fixed rate payments from the dealer. So this becomes a swap instrument. Let us talk about another scenario. So we have two borrowers, let's say borrower A and borrower B. This borrower A, if he goes to the market and tries to borrow, he will be borrowing probably, let's say 8% interest rate from the market at a fixed rate, and if he goes for floating, the bank is quoting him LIBOR plus 4%. If the borrower B goes to the market, let's say that the borrower B has a better credit rating, in that case the borrower B will be charged lesser rate of interest. Let's say that the borrower B is going to be charged at 7%, but if it goes for floating, then the bank asks to pay LIBOR plus 3.5%. Bank is not taking any risk on the floating rate side. So it is actually telling that, okay, for a fixed rate, I am going to charge 7%, but on a floating side, I will be charging LIBOR plus 3.5%. So if you see this whole scenario, the borrower B has a comparative advantage if it actually borrows at the fixed rate of interest, and borrower A has a comparative advantage of borrowing at the floating rate of interest. Because if you see that the borrower B is now getting 1% less interest rate if it borrows at fixed rate of interest, but the comparatively, if you see the floating rate of interest, this difference becomes only 0.5%. True? So borrower B has obvious advantage in borrowing at the fixed rate of interest, whereas the borrower A has the advantage of borrowing at the LIBOR plus 4%, that is the in floating rate of interest. Because borrower B, if it borrows at a fixed rate of interest, it is getting 1% less interest rate than the borrower A. If borrower B borrows at floating rate of interest, then it is only getting a 0.5% of advantage. So the relative advantage is higher on the fixed loan for the borrower B. On the other hand, for the borrower A, if it is borrows at fixed rate of interest, it is giving 1% more interest to the bank in case of fixed loan. But in case of a floating loan, it is only giving 0.5% extra comparative to borrower B. So borrower B has a relative advantage in a fixed rate loan, and borrower A has a relative advantage on floating rate loan. Now, can we think of a situation where we can reduce the cost of borrowing for the both borrower B and borrower A? Let us see. So borrower A goes to the bank and asks for floating rate loan, right? So it gets the loan at LIBOR plus 4%. That means the borrower A has to give to the bank at LIBOR plus 4% interest rate. Similarly, borrower B goes to the bank and it gets a loan at 7% interest rate. Now, both will decide that we will exchange our cash flows or we will exchange our loan. So borrower A goes to borrower B and asks for that, can you give me LIBOR plus 4.25% interest rate, and I am ready to give you 8% interest rate. What is the benefit of this kind of arrangement? Look at this. If borrower A gives 8% to the borrower B, which this 8% it would have anyway given to the bank, and in exchange it receives LIBOR plus 4.25%, whereas how much he is going to give to the bank is LIBOR plus 4%. So he is actually getting 0.25% extra. So he got plus 0.25%, and how much he is going to give is 8%. So if I will say that the interest rate that he is giving is in minus sign, then he is effectively giving 7.75%. So his loan obligation has come down to 7.75%. Instead of when he was going to the bank was quoting actually 8%, but now with this mechanism, he has reduced the cost of his borrowing to 7.75%. So there is a net gain of 0.25%. So he got a gain of 0.25%. Now this is the borrower A's gain. Then what happened to the borrower B? Whether the borrower B has lost in this transaction, let us try to find out, right? So borrower B was actually borrowing at 7% interest rate. Now it has got 8%, so it has gained actually plus 1%. Because He is getting at 8% interest. He is giving 7% to the bank. His net gain of 1%. Now let's see that he is actually giving the floating cash flow at LIBOR plus 4.25%. Had he gone to the bank, he would have actually given to the bank as LIBOR plus 3.5% only. So here he has given actually extra 0.75%, right? So his net outflow in the floating arrangement actually has become minus 0.75%. Now if I sum this up, plus 1% and minus 0.75% is actually he is in a net gain of 0.25%, right? So in this type of arrangement, both borrower A and borrower B has actually gained 0.25% each. It's clear now? In this type of arrangement, both the borrowers have reduced their cost of borrowings. So this is called the arbitraging their opportunities cost. This type of arrangement is also called a swap arrangement, right? Because a fixed type of cash flows is getting exchanged with a floating type of cash flows, and this is called the swap, right? This swap, where the interest rate is getting exchanged, is also known as, popularly called as, interest rate swap. So remember this mechanism of interest rate swap. We will go detail in other sessions. Today we will also learn about some other types of swaps, like say currency swap. The purpose of currency swap. Take a case that there is an exporter sitting in United States. He is selling the goods to UK consumers and receiving the pound sterling. The exporter has borrowed money from the lender or say bank in US dollar for his manufacturing activities, and then has to pay back in US dollar to close the loan along with the interest. So far so good. Now I am going to ask you some critical questions. So watch the video very carefully without missing any part. If you haven't understood so far whatever I have spoken, then please revisit the video and watch it carefully and get your concepts very clear. Okay, so here is the situation. The exporter is selling goods to the UK and is receiving the pound sterling, and he has the loan obligation to be repaid on US dollar. Now the question comes is that when he is receiving pound sterling, he has to sell pound sterling to bank or any other foreign exchange dealer to get the USD. The question comes here is that every time he receives pound sterling, he has to do this every time. This conversion exercise he has to do every time. Now, whether he will get the same amount of USD every time he does the conversion, the answer is no, because the exchange rate doesn't remain constant over a period of time, right? If you haven't understood what is exchange rate, I would suggest please visit some of my videos on foreign exchange and exchange risk. I have covered them in detail, and I will mention those links in this description box. Kindly revisit them. So coming to our point, right? Every time the exporter is trying to sell the pound sterling and trying to receive or get USD, he may not get the same amount of USD. If today the exporter is selling 1 million of pound sterling, he may get 1.25 million USD. But after 6 months, it may so happen that the same 1 million pound sterling may fetch him just 900k of USD. And this could be disastrous for him. The entire profit may go. He may have to forgo the entire profit, and sometimes some of the companies have previously filed bankruptcy just because of the exchange rate fluctuations. In history, like in Asian financial crisis in 1997, several companies filed for bankruptcy just because of exchange rate crisis. The exchange rate fluctuated so much that they were unable to pay off their international debt, and they entered into bankruptcy. If you want further details on Asian financial crisis, then mention that in comment box. I will try to make another video on that topic, which is also very important for your FRM exam. Coming back to our point, the exporter is facing a serious exchange risk. So the question comes to his mind is that how do I prevent? Because the exporter should not be worried about the exchange rate. Rather, he should be worried about his goods. He should be worried about the quality of the goods. He should be worried about how my consumers will be satisfied with my goods. What type of goods my consumer wants, rather than focusing on the exchange risk. He would rather prefer that there should be some kind of instrument that his banker should provide to him so that he can prevent the exchange risk. The most popular instrument to prevent this exchange risk is called the forward contract, popularly known as forward contract. And the forward contracts that prevent the exchange risk is called the FX forward contracts. So in an FX forward contract, this exporter will go to the bank and will say that, okay, I will take one forward contract for, let's say, 6 months, and you tell me what will be the rate if I am going to sell pound sterling to you and how much amount of USD you are going to give to me. So that exchange rate will be fixed. So it will be fixed at today, and it can be executed after say 6 months of time. So this is a forward contract. Now the exporter knows that yes, after 6 months I am going to get this much of USD for every million of pound sterling. So he is now less worried about the exchange rate fluctuation that is going to happen in the market. But this is FX forward contract and it is valid for one term. But exporter is not doing business only for one period, right? The exporter is in the business for a long run. It could be spanning over several years. So what it is going to do then? So the exporter can ask the bank, okay, give me several such forward contracts. Say one will be for 6 months, one will be for 1 year, one will be for 1.5 year, so on. So that every time it receives pound sterling, it knows that how much of USD it can get, so that it can pay back its lender in USD, right? So in this way, he can actually hedge his exchange risk. Now, combination of this type of forward contracts, combination of several forward contracts become a swap, currency swap. This is popularly known as currency swap. This type of arrangement or bundling together of several forward contracts is called a currency swap. So currency swap is nothing but a series or a bundle of FX forward contracts. In the next session, we will then see the exact cash flow mechanism in a currency swap, how the cash flows happen on every 6 months, how does the exporter gets back the USD, and what type of contractual terms that it agrees with its bank for such type of mechanism. Thank you for watching this video. If you like this video, click on the like button and put your nice comments in the comment section. This is the only way that I will come to know that you are enjoying my video, and I will continue to publish many more videos on these topics. If you have not subscribed to the channel so far, click on the subscribe button and click on the bell icon also, so that whenever I will publish a new video, you will get immediate notifications. So thank you for watching this video, and do stay tuned for more such